Investing in commercial real estate can be a pretty daunting process, especially with the sky-high price tags that often come along with these deals. This can tend to scare a lot of people away from getting started in the first place and building their own real estate portfolio, but there are ways to get exposure to this asset class without cutting a huge check. So to help give you some ideas about how you can invest in commercial real estate if you're just getting started in your career and have limited access to funds, in this video we'll cover 3 ways to get in the game with less than $10,000 in the bank and how you can start building your portfolio today with a lot less money than you might think. So the first strategy here is the method that I actually used to make my first commercial real estate investment, and this involves working in the industry and investing alongside the company that you work for. At many smaller entrepreneurial investment and development firms, the deals that these companies put together are often capitalized primarily with equity from friends and family, sometimes with 30, 40, 50, or more investors on a single deal. And because of this, adding a handful of employees to the investor list often ends up not only being allowed, but actually encouraged by the company as a strategy to keep employees engaged in their work and to make sure that everyone within the company has access to these deals. Companies will often reduce the minimum investment required from $25,000, $50,000, or $100,000 in many cases to something like $10,000, $5,000, or sometimes even less. And by investing with the company that you work for, this has multiple benefits because you're not only getting exposure to commercial real estate as a passive investor in these cases, but you're actually training yourself to make investment decisions with your own capital on the line, and then you're working on these deals directly and learning how to manage a portfolio, add value, and ultimately sell deals at a profit. This also makes going to work every day a lot more fun and a lot more meaningful overall, since it's very different to go to work for a set salary and a small, often predetermined bonus than going to work to find and manage your own investment opportunities without the stress that comes along with striking out on your own. And if you can't find a job on the principal side of the industry where you're able to co-invest with your company, working in brokerage can also often open up opportunities to invest in deals you work on, since many of your smaller, more entrepreneurial clients will allow you to roll your commissions into a deal, which can sometimes be an even better situation than investing with your company, since this will give you even more exposure to different sponsors, product types, and sometimes even geographic markets, which can help you reduce your risk and diversify your portfolio. Now, if you don't want to be a passive limited partner and you don't want to or don't have the opportunity to invest with the company that you're working for, another way to invest in commercial real estate with very limited capital is to raise third-party equity as a sponsor on a deal. This is the traditional standard real estate private equity model where an investment firm, or even an individual in this case, will do the legwork to identify a property, put that property under contract, and then manage and ultimately sell the deal, ideally for a profit on behalf of other passive equity investors. And in exchange for that legwork, those passive limited partners will put up the majority of the equity required and pay the sponsor fees for that work they're putting in. Limited partner equity contributions often make up 90 to 95% of the overall equity requirement on a deal, and even if you're working on bigger transactions where the remaining 5 to 10% equity requirement is substantial, in many cases, those fees that you might generate as a result of acquiring the property in the first place can often make up the majority or even all of your remaining equity requirement. So for example, if you were to identify a $5 million property, you work with a lender to secure a $3 million 60% LTV loan, and then you go out and raise equity for the remaining $2 million required to close on the deal. If your limited partners put up 95% of the capital, this would make your equity requirement just $100,000 on the deal. And even though $100,000 is a lot of money, if you're charging a standard market rate acquisition fee of something like 2% of the purchase price for a deal of this size, that fee alone comes out to exactly $100,000, and many JV structures will actually allow you to roll that fee into the deal as your equity commitment, allowing you to control a $5 million asset for essentially nothing out of your own pocket. Now, obviously, in practice, there are going to be closing costs, deposit requirements, dead deal costs on acquisitions that don't end up working out, and other operating costs of striking out on your own. So ideally, you want to make sure to have as much of a cash cushion as possible if you do choose to go this route. But if you personally have very limited funds and you've built up a strong network and a skill set to be able to identify, acquire, and manage commercial real estate, when you start to do the math, the out-of-pocket requirements to raise capital and do deals is significantly less than it might appear to be upfront. And then finally, if you're not up for investing with the company that you work for or raising capital to do your own deals, the last option here is available to almost anyone, and this is investing in publicly traded REITs. Now, I'm not a huge fan of this strategy, especially if you're in the industry already and you know how to analyze individual deals, primarily because a lot of the tax benefits that you'll get from investing directly in commercial real estate tend to go away by going this route, and distributions made from REITs are generally going to be considered ordinary taxable income. But if you don't have any other options and you want to get in the game with very limited capital, buying REIT stock can be a great way to do it. The National Association of REITs, or NAREIT for short, is a great online resource to research the options out there, and because these are publicly traded companies, there is a lot of information that you can sift through on each company's portfolio and their operations. And aside from the benefit of transparency, another major benefit of investing in REITs is the level of diversification that these types of investments will typically give you, which is very difficult to match when investing in deals directly. Publicly traded REITs are generally extremely large companies with extremely large portfolios, and by buying REIT stock, you can immediately get exposure to real estate assets across the entire country or even the entire world. And by buying a handful of different REIT stocks, you can also get access to different product types as well. Because you're buying a piece of an entire company, distributions also tend to be slightly less volatile than what you might see when investing in individual properties. And while stock prices can fluctuate pretty wildly on a day-to-day basis, if you're a long-term buy and hold investor that believes in a certain asset class or a certain geographic market, buying and holding REIT stock long-term can be a great way to get exposure to real estate while also keeping your capital liquid and diversified in the process. When I was early on in my career, one of the things I heard over and over again from people who had been in the industry for a while was that these people wished they had bought more sooner, and only a little over a decade into my own career, I already feel the same way. So if limited access to funds is stopping you from getting in the game at all, these are 3 ways to start building your real estate portfolio, and some things that helped me when I was first getting started. And if you want to learn more about real estate investment analysis, whether you're investing in deals directly or you want to make sure you have the skills you'll need to be able to land a job at a top real estate investment or development firm, as always, make sure to check out our all-in-one membership training platform, Breaking the CRE Academy. A membership to the Academy will give you instant access to over 120 hours of video training on real estate financial modeling and analysis. You'll get access to hundreds of practice Excel interview exam questions, sample acquisition case studies, and you'll also get access to the Breaking a CRE Analyst Certification exam, which covers topics like real estate pro forma and development modeling, commercial real estate lease modeling, equity waterfall modeling, and many other real estate financial analysis concepts that will help you prove to employers that you have what it takes to tackle the responsibilities of an analyst or associate at a top real estate firm. And if you like this video and want to see more content on this channel on different investing strategies and options in the market, make sure to hit the like button to let me know, and let me know in the comments any other strategies that you've used to get exposure to real estate without having millions of dollars sitting in your bank account. As always, thanks so much for watching, guys. I hope you found this helpful. Subscribe to the channel if you haven't already to see more videos like this every single week, and I'll see you in the next video.